When should I buy a stock exactly? That's the question you asked. That's the question we're going to try to answer today. We're going to go from technical analysis all the way to intrinsic value, and we're going to find the answer to that question here on this video right now. Let's get on with it. Welcome to Tomorrow Venture Investing. First up, we're going to address is FOMO. And for those that don't know, FOMO is the fear of missing out on a good deal, or what seems to be a good deal at the time. Many of us in our investing careers might even be a victim of FOMO. Hype is a big contributing factor to FOMO. Stocks that were hyped up in the past, in addition to meme stock, one might actually jump in on a stock thinking, hey, it's going to the moon. I mean, when do you jump in on a stock that is skyrocketing up? This strategy doesn't always have a high probability that you'll buy at the bottom and not at the top, where most of the investors buy in at and end up selling for a loss. FOMO, seeing a stock shooting straight up, getting on that gravy train, usually doesn't work out, because normally when we find out that it's a hype stock, it's usually run its run, and before long we end up holding the bag at the end, as most of us usually have done. Technical analysis. These are a lot of indicators, advanced chart reading, and one of those so happens to be moving averages. That is a line that is drawn across the graph, four of them actually, a 25-day, a 50-day, and a 100-day, 200-day as well. And these are the average stock price over that period of time. As these lines draw along with the graph is drawn, if these particular lines cross over each other, like the 100-day were to cross over the 200-day, that would be a buy signal. And as the 100-day crossed it back over the 200-day, that would be a sell signal in the moving average of advanced chart reading. As shown here, we have the four flowing lines at the top, indicating the moving averages, and here is where the 100-day crossed over the 200-day. The orange line crossed over the red line. This would be a buy signal. Looking at this chart, we also should mention that the price of the stock has increased above and has time broken through all four moving averages. This is also an indicator to people who are trading with moving averages. Are you enjoying this video? Then what are you waiting for? Go ahead and give us a like. It's free, and it really helps out with the algorithm. And since you're hitting that like button, you might as well go ahead and subscribe to it. It's right there next to it. And hit that notification bell too, so you can get more awesome videos just like this one. And now, back to our normal scheduled programming. Another technique we use to identify when to buy a stock is engulfing green candlesticks. Using this indicator, along with other indicators that we will talk about here shortly in the future, will determine if you should buy a stock or not buy a stock off the technical analysis point of view. Along with that indicator, you also need to value the volume. A large volume going into the stock, along with engulfing green candlesticks, can be an indicator to buy a stock from the technical analysis point of view. In addition to having great volume into a stock, there's also a stochastic. Percent K is one of them. There at the bottom in this graph, we have two red lines horizontally. And we got the squirrely lines going up and down through them. At the bottom of this graph, you have what is called a stochastic. You have two red horizontal lines. One of them is 32%. One of them is the 80%. You also have the squirrely lines that go up and down above them and below them. And as those squirrely lines get below, that is an indicator of an oversold stock. And as it crouches up over the 32%, and as it goes to the 80% line or above, that is an indicator is overbought stock. So generally what you're looking for is when the lines start to go right into the out of the oversold into the over the 32% and starts heading toward the 80%, along with some engulfing green candlesticks and great volume, you might have a great indicator of when to buy a stock. If you don't have any of these, or you're missing one of these, especially the volume, then this is not a good time to buy a stock and you should not buy it. With the percent K stochastic, with the lines indicating an overbought and oversold, in addition with engulfing green candlesticks and great volume, as we mentioned before, are all great indicators of when to buy a stock. Using the technical analysis as indicators is also helping you map the course path of where the stock is headed, whether it's heading up or it's heading down. Using these indicators will help you determine when you should buy a stock exactly. Knowing the company. So many people buy stocks of companies that they don't even know. Knowing the company. Now, just think for a second. The stocks that you are invested in, can you tell me in 20 seconds what the company's all about, what it does, what it's going to do? Other than I'm invested in this thing because I think this sucker's going up. I mean, come on. Can you tell me anything else about the company other than you have a really good feeling? Knowing the company is also knowing any potential future growth that company has to offer. If they're a manufacturing stock, are they building any more manufactories? Or are they coming out with new products? These are all future growth that's going to help you indicate when you should buy a stock or when you should not buy a stock. Knowing the company will help you identify the intrinsic value. This is one of Warren Buffett's advice. Figuring out the intrinsic value of something and then going and buying it for a lot less. There are all kinds of ways and methods to figure out what the intrinsic value of a stock is. One of those is DCF, which represents discounted cash flow. DCF is commonly used to identify a intrinsic value of a stock. And it's pretty much using the cash flow of this year and years in the future that you think the company is going to do and discounting them to find out the actual intrinsic value. It's a bit more complicated than just that. You have to use numbers of revenue. Some people use as analysts' expectations. And putting all that together will help you know when to buy a stock exactly. Intrinsic value, finding out what you feel the stock is worth and then buying it for a lot less. This will help you know when to buy a stock. And yes, when you buy, the stock may drop even lower. But look, this is what it boils down to. Is it a good deal today? If it's a good deal today, then you buy it today. If that were to happen, the price fall after you done purchased it at a pretty good price, or what you believe is below the intrinsic value, you go ahead and buy some more. You want to average your costs down. I don't get it. The stock market's the only thing that I've seen where stocks lower in price and people don't want it. I mean, when you go to the store, when you see something 50% off, you're like, oh God, this 50% off, I'm going to grab a whole bunch of it. But when it's $85, you're like, oh no, I can't buy that at $85. That's the way you should think about stocks. When stocks drop lower, you already bought it at a good deal. Why not lower? Isn't that a better deal? One of my personal indicators is know when you feel comfortable with the volatility and the associated risk when buying stocks, especially stocks that aren't cash flow positive, aren't making a profit. Stocks that may drop 5-10% or go up 5 or 10%. Another guideline I use is when the intrinsic value that I put on a stock is lower than what the market is saying. Taking the world around us may also help us determine when we should be buying a stock or not buying a stock. Knowing what's going on in the world around us will help us add and subtract our intrinsic value that we have placed on some stocks that we might be looking at the time. One thing I have learned in my investing career is when it's a good deal, you buy the thing, regardless if you feel like it may drop tomorrow or not. I cannot begin to tell you how much money I have missed out on from gaining because I waited to buy a stock, even though at the time it was a really good deal. But I felt like, hey, let's wait a minute. Let's see if it'll drop a little bit more. And then you get into that continuous loop. And before you know it, it skyrockets and you're thinking, hey, it was a good deal. Why didn't I buy some? I'm pretty sure many of you have already experienced this. Trying to time the market, I believe, is an impossible task. Some do get a lucky break. But what it all boils down to is finding indicators that you're comfortable with, and then putting all that together to find out when exactly you should buy a stock. Although having a crystal ball doesn't hurt. Hey, thanks for watching Tomorrow Venture Investing. If you've not done so, hit the like button and subscribe. And also, if you like, leave a comment. Let me know if you enjoyed this video or not. According to the YouTube algorithm, they suggest you should watch this video next. And I want to take this time out to thank you. Thank you so much for watching all the way to the end. I appreciate it.